Imagine building a company so big, you've got 31 million customers, and you're being called the Amazon of furniture. And somehow, after all of that, you've lost $4.5 billion. Not over some catastrophic single event or fraud, just slowly, steadily, year after year. And the 1 year you actually turned a profit, it took a global pandemic to make it happen. This is the story of a company that got a gift, thought it was normal, and paid for that mistake for years. By the end, the CEO himself would write a letter that would become one of the most talked about corporate memos in recent memory. In the early 2000s, Niraj Shah and Steve Conine had an idea. Home shopping was still mostly confined to store shelves, but they saw a future where people would buy furniture and home goods online. So they started a company called CSN Stores. It wasn't just one website, but over 200 of them. Each one sold something specific. One did bar stools, another was for bedroom furniture, and another one for lighting. If it went in a house, CSN probably had a site for it. Because they didn't have much money, the lack of resources actually forced them to be disciplined, to prioritize relentlessly. That scrappiness worked, and the business grew. Then, in 2011, they made a big decision. They merged all those niche sites into a single platform and gave it a new name: Wayfair. Now, there was one place where you could find anything for your home at any price point in any style. And it caught on. By 2014, the company was growing fast enough to go public. On October 1st, 2014, Wayfair priced its initial public offering at $29 a share and started trading on the New York Stock Exchange the next day. Goldman Sachs was the lead bookrunner, and the company was officially in the big leagues. And then they did what fast-growing tech companies usually do. They grew fast, really fast. Revenue went from $6.8 billion in 2018 to $9.1 billion in 2019. That's 35% growth in a single year. The customer base was exploding too. They went from about 15 million active customers in 2018 to over 20 million by the end of 2019. Shah was telling investors they had barely scratched the surface of their total addressable market. But despite all that, Wayfair wasn't making any money. In 2018, the company lost $504 million. In 2019, the loss nearly doubled to $985 million. Free cash flow was negative $598 million that year. The company was burning through cash while trying to convince everyone it would all pay off eventually. And they were spending big to fuel that growth. They expanded internationally into the UK, Canada, Ireland, and Germany. They built out a massive logistics infrastructure, and they hired aggressively. Shah would later admit that from 2017 to 2019, they opened up hiring significantly, going after many things that looked like good opportunities. The result was that by late 2019, they were lacking focus. They had too many good ideas, and only a few of those were ever getting done. To fund all of this, Wayfair was loading up on debt. Long-term debt went from $739 million at the end of 2018 to $1.46 billion by the end of 2019. The company recognized the problem. In February 2020, they laid off 3% of their workforce, trying to get back to basics. Then something nobody could have predicted happened. COVID-19 hit, and suddenly everyone was stuck at home. People who'd never thought about redecorating were staring at their living rooms for 16 hours a day, and they started buying. Because you couldn't go to a furniture store, Wayfair was perfectly positioned, and the numbers were staggering. Revenue jumped from $9.1 billion in 2019 to $14.1 billion in 2020, a 55% increase in a single year. Active customers surged from 20.3 million to 31.2 million, up 54%, and for the first time in the company's history, Wayfair actually made money. Net income for 2020 was $185 million. Adjusted EBITDA, which is basically operating profit before some accounting adjustments, swung from negative $497 million in 2019 to positive $947 million in 2020. That's a $1.4 billion turnaround in 1 year. Free cash flow went from negative $598 million to positive $1.08 billion. The cash pile grew to $2.6 billion. It looked like Wayfair had finally figured it out. The years of losses were behind them, and the future was bright. Except when the world changed back, Wayfair was going to be in serious trouble. Because during this boom, the company did something that would haunt it for years. They grew their team and took on even more debt, pushing long-term borrowings to around $2.66 billion by the end of 2020. Wayfair had just gotten a once-in-a-lifetime gift, but instead of banking it, they spent it. They aren't the first company we've covered on this channel that got stung because they thought a pandemic boom was the new normal. If you're still watching, you're exactly who this channel is for. We're trying to get to 100,000 subscribers in 2026. And by clicking that subscribe button, you don't just stay in the loop for future videos. You help us to grow and make the best content we can. Thank you. In 2021, revenue slipped to $13.7 billion, down about 3%. That doesn't sound bad until you look at the details. Active customers dropped from 31.2 million to 27.3 million, a 12.5% decline. Orders delivered fell from 61 million to 52 million. The company swung back to a net loss of 131 million. Free cash flow cratered, and debt kept climbing, hitting just over $3 billion. But 2021 was just the warm-up. In 2022, retailers across the board were seeing weaker furniture sales as inflation squeezed consumers. Wayfair lost about 5 million customers in a single year. Revenue fell to $12.2 billion, down nearly 11%, and the net loss exploded to $1.33 billion. A company doing $12 billion in sales lost over $1.3 billion in a single year. Their cash pile, that had been $2.6 billion at the end of 2020, was now down to $1.3 billion. Meanwhile, the company was paying $527 million a year in equity-based compensation, basically stock awards to employees, while the business was hemorrhaging cash. In August 2022, Wayfair made its first round of cuts, about 870 jobs, or roughly 5% of the global workforce. The stock dropped around 17% on the news. It wasn't enough. 5 months later, in January 2023, Wayfair cut 1,750 more jobs as part of a wider $1.4 billion cost-saving plan. This time, the stock jumped as much as 26%. Combined with the August layoffs, the company said the labor savings totaled about $750 million. By the end of 2023, the full-year net loss had come down to $738 million from $1.33 billion. Free cash flow improved by over $1 billion, going from negative $1.13 billion to roughly breaking even. But it still wasn't enough. On January 19, 2024, Wayfair announced yet another round of layoffs. This time, approximately 1,650 employees. The expected savings were more than $280 million a year. But what made this round different was the letter. Shah published a note to all employees that became public, and it was remarkably blunt. He laid out how the company had been lean and focused in its early years, how they started spending aggressively from 2017 to 2019, how COVID created a surge that made them want to hire all over again, and how by mid-2022, it was clear they were in a bust period. He wrote that we went overboard in hiring during a strong economic period and veered away from our core principles. He explained that the company had already done 2 major restructurings since 2022, and each time they'd used their best judgment and believed they were resizing to the right point. but each time they found they still had too many people. Then came the line that got everyone's attention. In many ways, having too many great people is worse than having too few. With too few, you get a lot done quickly, but you may not get everything done that you want. But having too many causes inefficiency, coordination costs, and investments in lower return activities. He said the goal this time was to err on carrying a risk of too few over the risk of too many, and he closed with a line that was either optimistic or delusional. Our toughest stretch is now behind us. The 2024 full-year numbers show a company that got leaner but still couldn't grow. Revenue came in at nearly $12 billion, down another 1.3%. The net loss was $492 million, better than the year before, but still a loss of $500 million. And the customer base kept shrinking. Active customers fell to 21.4 million, down another 4.5%. That's down from 31.2 million at the peak. Wayfair has lost nearly 10 million customers since 2020, and their accumulated deficit, which is basically the running total of all the money the company has ever lost, was over $4.5 billion at the end of 2024. Then, in January 2025, Wayfair announced it was exiting Germany entirely and laying off another 730 employees. The company expected to take charges of 102 to 111 million to wind down its German operations. The international push that was meant to be a growth engine turned out to be a money pit. Shares went up about 4% on the Germany exit news. The market had learned to reward Wayfair for getting smaller. Add it all up, and since August 2022, Wayfair has cut roughly 5,000 jobs across 4 rounds of layoffs. The company that once employed over 16,000 people and was adding people as fast as it could has spent 3 years doing nothing but shrinking. If you want to know who else is shrinking right now, read my newsletter. I go over distressed debt, leveraged finance, bankruptcies, and restructuring company research to grow your finance knowledge. Click the link in the description. And then came 2025. For the first time since the pandemic, revenue actually grew. Full-year net revenue hit $12.5 billion, up 5.1% from the year before. The company even posted $17 million in income from operations for the full year, the first time that line had been positive since 2020. Shah called it a year where our share capture overwhelming the drag of the macro. On the surface, it looks like a real turning point, but look closer and the familiar tensions are still there. The net loss was $313 million. Active customers barely budged, sitting at 21.3 million, down slightly from the year before. The accumulated deficit climbed to $4.82 billion. Long-term debt rose to $3.23 billion, and there was yet another workforce reduction in March 2025, with 20 million in related charges. The Germany wind down continued to cost money too, adding 48 million in restructuring charges. Wayfair is undeniably in better shape than it was in 2022, but better than the worst year in company history is a low bar, and the company still hasn't posted a full year of actual profit since a pandemic handed it one. The Wayfair story isn't about a company that made a bad product or forgot who it was. People actually like buying stuff on Wayfair. The repeat customer rate was nearly 80% by the end of 2024. The problem was that Wayfair spent years building a cost structure that only worked during a pandemic, and when the pandemic ended, they were left with a company that does nearly $12 billion in annual revenue and still can't turn a real profit. Shah said in his January 2024 letter that a company cannot win over time unless it gets more done per dollar spent than its competitors. He's right, and by that measure, Wayfair has a long way to go. The company has never posted a profitable year on a standard accounting basis except for 2020, the year a virus did its marketing for it. every other year has been losses and a growing deficit. Wayfair has proven that you can sell $14 billion worth of furniture and still be $4.5 billion in the hole. You can have 31 million customers and still not have a sustainable company. Growing isn't impressive if every dollar costs you more than it brings in. And sometimes it takes a CEO writing a brutally honest letter to finally say what everyone already knew. To watch more videos about companies whose customers cost them more than they create, click on the links above.